Hi, I'm Patty Healy, Senior Vice President of Credit Research at Cumberland Advisors. I'm filling in this week for Matt McAleer's Week in Review. Matt, as most of our viewers know, is up in Saratoga Springs, New York, enjoying the horse races and all the festivities that are included around that activity. He's also probably using his very well-honed analytical skills to handicap the horses. Okay, so now on to market activities today. So this week there was a lot of good or positive economic information coming out. Corporate earnings were better overall than most expected, notwithstanding Amazon. And the GDP number that came out this morning really gave a good bump to the stock market today, where all three major indexes closed at or near their highs. So the bond market over the week, the 10-year bellwether bond had a yield of 2.04% on Monday, and by the end of the week it was 2.07%. So we got a little bit, we're creeping a little higher in yield, as John Musso mentioned last week. Seems that's what's going on. And everyone is waiting next week for the Fed to make a decision on what they're going to do with rates. It's pretty much baked into the market's expectations that there's going to be a rate cut. Earlier in the month, it was definitely going to be a 50% rate cut. Now it seems like the market's thinking more it'll be a 25% rate cut. However, we've mentioned in the past that the Fed is data dependent, and some of the numbers that came out this week, in addition to increased GDP, there was also durable goods orders were up, as well as inventories were down, some from inventory management, but also from better retail purchase, the strength of the consumer and the economy. So I just want to make a couple of comments on corporate bonds. Corporate earnings have been better than expected, though there are people out there that think in the next quarter maybe the numbers won't be so good. We'll see what happens with that. But corporations, because of the low level of interest rates, have been borrowing and leveraging themselves. They've been leveraging themselves to buy back shares, which helps share prices, and they've been leveraging themselves to do acquisitions. And this makes total sense. Cheap money is cheap, so they're borrowing a lot. However, this increased leverage has caused downgrades by the rating agency, and the average corporate bond rating is kind of going down and down. This contrasts with municipal bonds, which have been going up in credit quality lately. And I know municipal bonds might lag corporate bond behavior because of they're affected by what happens at the companies as far as employment and what have you. So corporations have been leveraging themselves, and they've been downgraded. This is in contrast to municipal bonds, which have been gotten upgraded more so than have been downgraded. Notwithstanding the outliers, the ones that you hear about in the news all the time, but overall the credit quality of municipal bonds has been going up. Also, with low interest rates, investors are looking for yield. They're going down the credit quality spectrum to get a little bit additional yield, and interest rates are so low there's really not that much spread differential. So here at Cumberland Advisors, I think as most of our viewers know, we are a high quality shop for a number of reasons, because we're active managers and because there's more liquidity in higher rated bonds, and our clients our viewers or our clients like us like to sleep well at night. So we have over the past year have been actually upgrading our portfolio credit quality in both our taxable and our tax exempt strategies. Thank you, and as always, we welcome your comments and feedback. Thank you.